It is February 14th, 2026. And while, half the country is probably scrambling for dinner reservations right now, we are looking at a very different kind of milestone.
Mm.
Because as of December 2025, just 2 months ago, there are now only 5 Sears stores left. 5. In the entire United States.
5. It's a number that just doesn't compute, does it?
Yeah.
It feels wrong, especially when you think about the sheer scale of what this company used to be.
It feels like a typo in the data. You've got 2 in Florida, and one of them's been operating since 1954, which is incredible, and then a couple others scattered around. But that's it.
That's the list.
And if you're, say, 20 years old listening to this, Sears is probably just a ghost. It's that empty building at the mall where the Halloween store pops up in October.
Right, it's a relic.
Mm-hmm.
But the sources we're diving into today, the internal records, the financial filings, they tell a story that is so much bigger than just a store going out of business.
Oh, it's not a business failure. We're looking at the fall of an economic nation state.
That's not hyperbole. That is the only way to describe it.
The numbers are just staggering. At its peak, Sears wasn't just the biggest retailer. It accounted for 1% of the entire U.S. gross domestic product.
1%.
Let that sink in. Think about that. That's like if you took Amazon and Walmart and maybe Google and smashed them all into one single entity. That was Sears in the 1970s.
And that's our mission for this deep dive. We're not here to just, get nostalgic about the smell of Craftsman tools and popcorn. We need to unpack how a company that was literally Amazon before Amazon managed to lose everything.
And we have the documents to do it. We've got the extensive Wikipedia archives for both Sears and Sears Holdings, the 2018 bankruptcy filings, and some of the internal memos from what we have to call the Hedge Fund Era.
Ah, yes, the Lampert years. That's where things they get really interesting from a financial engineering perspective.
And we are definitely going to spend a lot of time there. But to really understand the fall, you have to understand the ascent. Because the story doesn't start with the department store. It doesn't even start in Chicago.
No. It starts on a dusty railroad platform in North Redwood, Minnesota in 1886. And it all began with a box of watches and let's call it a slightly sketchy wholesale tactic.
This is the Richard Warren Sears origin story. And I love it because it's not some grand vision. It's just a guy spotting a simple inefficiency in the market.
Exactly. Richard Sears was a railroad station agent, so he's the guy running the local depot. And one day, a shipment of gold-filled pocket watches shows up, addressed to a local jeweler.
But the jeweler didn't order them.
Nope. It was a classic, slightly shady move back then called unsolicited shipping. The wholesaler just sends the product, hoping the local guy feels pressured to pay for it just to get rid of it.
And the jeweler said, no thanks.
He refused the shipment.
Mm-hmm.
So now Richard Sears is just standing there on the platform with a box of watches nobody wants. The average person would have just shipped them right back.
But Sears wasn't the average person.
Not even close. He opens the box, looks at the manifest.
Yeah.
The wholesaler wants $12 per watch. Sears knows from, just being alive, that a watch like that retails for about $25 in a jewelry store.
So he sees the spread.
He sees the arbitrage. Instantly. He realizes he can send telegrams up and down the rail line to other station agents and sell them the watches for $14.
So he undercuts the jewelers, makes a $2 profit on every watch, and he doesn't need a storefront. He doesn't need inventory.
He just needs the railroad.
Yeah.
It was his distribution network. It was brilliant. He eventually teamed up with a watch repairman named Roebuck, which makes sense because if you're selling watches, you need someone who can actually fix them.
Right. Sears was the salesman, not the technician.
Precisely. And they moved the whole operation to Chicago.
Okay, let's pause there. Why Chicago? The sources really hammered this point home. It seems critical.
Because in the late 19th century, Chicago was the internet. It was the central node. It was the hub for the entire North American railroad network. If you wanted to ship something from the coast to the heartland or vice versa, it had to go through Chicago.
It was the physical server for the country's logistics.
Perfectly put. If you put a package on a train there, you could reach almost any corner of the country faster and cheaper than from anywhere else. Geography was destiny for them.
So they're in the right city. In 1893, they officially become Sears, Roebuck and Company. And then comes the real revolution, the big book.
The catalog. And it's almost impossible for us now to understand how groundbreaking this was. By 1894, it was 322 pages. Just 1 year later, 1895, it's over 500 pages.
And it had everything. Sewing machines, bicycles, musical instruments. I saw in the notes they even sold automobiles for a while.
They did. From 1905 to 1915, it was called the Sears Motor Buggy. It would arrive in a crate at your local train station, and you'd have to, do some final assembly.
You could mail order a car? That's incredible.
It is. But the car is just a fun detail.
Yeah.
The real innovation was the information itself. The catalog became known as the consumer's Bible.
And I want to dig into that name because it wasn't just about convenience. The sources point to a very specific reason it exploded in rural America. It was a way to escape a monopoly.
You're talking about the local general store. If you're a farmer in, say, rural Mississippi in 1890, you have one place to buy things. One, the guy who runs that store sets the prices. He decides what you can and can't buy. There's no competition. The markup was insane.
And this is where a really important social dynamic comes into play, something the history often glosses over. For African-American families, especially in the Jim Crow South, that local store wasn't just expensive. It was often a place of profound humiliation.
This is a crucial part of the story. A black family could walk into that store and be ignored, be refused service, or be charged double what a white customer would pay. They could be denied credit. It was an instrument of economic oppression, designed to keep people in their place.
But the United States Post Office doesn't care about the color of your skin.
Exactly. The mailman is a federal employee. He has a mandate to deliver the mail. He delivers the package, no questions asked. With the Sears catalog, you filled out a form, you sent in a money order, and that was it. You got the same plow, the same dress, the same seeds, at the exact same price as a white family in Ohio.
It provided anonymity and dignity.
It was an economic lifeline. It allowed black families to bypass those racist local power structures and participate directly in the national economy on an equal footing. It built a kind of brand loyalty that you can't buy with advertising.
That's a powerful foundation. And on a more utilitarian note, the book itself was physically valuable, right?
Ah, yes, the toilet paper thing.
The toilet paper thing.
The catalog was printed on a specific kind of uncoated newsprint. So in rural homes with an outhouse, once the new updated catalog arrived in the mail,
The old one got a second life.
the old one was hung on a nail and recycled page by page. It was, in a very real way, an essential part of daily life.
Yeah. Talk about market penetration. Okay, so they're the undisputed kings of mail order. They are the Amazon of their day. But then trouble starts brewing. Not in the company, but in the country itself.
Right. There was the Panic of 1893, which was a huge economic depression that nearly bankrupted them early on. That's actually when Alva Roebuck got scared and sold his share of the company.
He left. So it should have been Sears and Rosenwald.
It really should have. Julius Rosenwald came in around 1895. He was the operational genius. If Sears was the visionary marketing guy, Rosenwald was the one who actually built the rational, efficient systems to make it all work. He's the one who took it public in 1906, the first major retail IPO in American history.
But the bigger threat wasn't a financial panic, it was a demographic shift.
It was urbanization. This is where a man named General Robert E. Wood enters the picture. He took over after Rosenwald shifted his focus to philanthropy. Wood wasn't a merchant. He'd worked on the Panama Canal. He was a military logistics guy, a numbers guy.
And what did the numbers tell him?
He looked at the 1920 census data and saw something profound. For the first time in American history, more people were living in cities than on farms. And, maybe even more importantly, they were buying cars.
So the whole business model, which is built on serving isolated farmers via mail, is suddenly under threat.
It's facing an existential crisis. If your customers are all moving to the city, they don't need your catalog. They can just go to a store.
But Wood's insight was that they weren't going to the right kind of store.
Exactly. The big fancy department stores of the day, your Macy's, your Marshall Field's, were all downtown. They were these grand, multi-story palaces built for people who arrived by streetcar or on foot.
They were urban cathedrals of consumption.
Right. And Wood looked at the data and said, no, that's not the future. He realized the working class wasn't living downtown. They were living in neighborhoods further out. And they were driving. He said, we're not going to build where the rich people shop. We're going to build where our customers live. And we're going to build for the automobile.
Which meant one thing above all else.
The parking lot.
It sounds so incredibly basic now. Of course a store has a parking lot.
But in 1925, it was revolutionary. To dedicate a huge, valuable piece of land to just storing cars for free was a radical idea. Competitors thought he was insane, but he was betting everything on the car, and he was absolutely right. The first Sears retail store opened as an experiment in their Chicago catalog plant in 1925. It was a madhouse, an instant success.
And they didn't just innovate on the outside of the store, they changed the inside too. The sources mention these windowless stores in the 1930s. That sounds kind of grim.
It sounds like a bunker, but it was pure efficiency. Think about it. If you have no windows, you gain all that wall space for shelves. You control the lighting completely, so every product looks perfect. And this is the big one in the 30s. You can air condition the entire space.
You create a self-contained world.
A hermetically sealed temple of commerce, where the only thing that matters is what's on the shelves. It's the logic casinos use, but applied to retail. They were the first to do it.
And they also tore down the walls between departments, right?
Yes. Before Sears, a store was like a collection of little shops under one roof. The shoe department was its own world. The men's department was separate. Sears created the first truly open-plan selling floor, so the hardware section could flow right into sporting goods, which flowed into automotive. It was designed to encourage browsing, to make you wander and discover things you didn't even know you needed.
It's the blueprint for Target, right? For Walmart, for every big box store that came after.
It is the blueprint. And they used this model to conquer the suburbs. After World War II, as the suburbs exploded, Sears was right there. They became the anchor tenant that made the American shopping mall possible. If Sears didn't agree to open a store in your new mall, the developer couldn't get the financing to build it. They were that powerful.
And they built their own universe of brands. Kenmore Appliances, Craftsman Tools in 1927, Die Hard Batteries in 67.
Vertical integration at its finest. They didn't just sell you a wrench, they sold you a Craftsman wrench with a lifetime guarantee. They didn't just sell insurance. They founded Allstate in 1931 and literally put the insurance agents at desks inside the stores.
So you could buy a new set of tires, get a Die Hard battery, and get them insured with Allstate, all without leaving the building.
It was an ecosystem. They owned every part of the American dream, from the lawnmower to the life insurance policy, and the ultimate symbol of that power was the Sears Tower, completed in 1974, at the time, the tallest building in the world.
And when you look at the timeline, 1974, that's it, isn't it? That's the absolute peak.
That is the summit. And there's a concept in business called the edifice complex. It's this theory that as soon as a company builds a massive, record-breaking headquarters as a monument to its own success, it's usually a sign that the decline is about to begin.
Because they've stopped looking out at the customer and started looking in the mirror?
Exactly. And that brings us to the 1980s and the beginning of the Great Unraveling. It wasn't a sudden crash. It was a slow, creeping drift into confusion.
This is the socks and stocks era.
Socks and stocks. The leadership at Sears looked at their core retail business and thought, this is boring. The margins are thin. They got seduced by the high-flying world of finance.
So instead of trying to sell more jeans, they decided to sell, what, mutual funds?
Exactly that. They went on a buying spree. They bought Dean Witter, a major stock brokerage. They bought Coldwell Banker, the real estate giant. And they launched their own credit card, the Discover Card.
I mean, I can almost see the logic on a PowerPoint slide. You buy your house with Coldwell Banker, you insure it with Allstate, you fill it with Kenmore Appliances from Sears, and you put it all on your Discover Card. It's the life cycle pitch.
It was pitched as the Great American Financial Network. But the reality was, it was a catastrophic distraction. Retail is a daily ground war. It's about pricing, inventory, customer service, store cleanliness. It requires relentless focus.
And the CEO can't be focused on that if he's worried about interest rate spreads and the real estate market in California.
Precisely. While the top executives were playing Wall Street, the actual stores, the things generating the cash, were being neglected. The paint started to peel. The carpets got worn. The product mix got stale.
And while Sears was looking the other way, the competition was getting fierce.
Oh, the sharks were circling. Sam Walton was building a logistics machine at Walmart that made Sears look ancient. Home Depot was creating a warehouse model for hardware that made the Sears tool department look like a tiny closet. Best Buy did the same for electronics.
They were being carved up by these category killers.
Piece by piece. And then, in 1990, the unthinkable happened. Walmart officially surpassed Sears as the largest retailer in the United States.
And just 3 years after that, in 1993, they make what might be the single worst business decision of the 20th century.
They kill the catalog.
They discontinue the big book. After 100 years...
Let's just frame the timing here. They shut down their mail order business in 1993. Jeff Bezos incorporates a company called Cadabra Inc., which would later be renamed Amazon in 1994.
It's the ultimate what if. It's just, it's painful to think about. Sears had everything. They had the warehouses, the trucks, the customer data, the brand trust.
They had a 100-year head start on Amazon. If they had just taken that catalog infrastructure and put it online, we would all be Sears Prime members today. There would be no Amazon.
But they saw it as a cost, a legacy business to be cut.
They were managing for the next quarter's earnings report, not for the next decade's economy. They saved a few $1 million printing and mailing books, and in doing so, they threw away a $1 trillion future.
And on top of that, the trust they had built for a century was starting to crack. The Auto Center scandal in 1992 was a huge blow.
It was disaster for the brand. The state of California sued them, and the investigation found that Sears Auto Centers were systematically ripping off customers.
Ow. What were they doing?
They had put their mechanics on a commission and quota system. Management told them, you need to sell, for example, 5 brake jobs per shift to hit your numbers.
So suddenly every car that rolls in for an oil change mysteriously needs new brakes.
You got it. They incentivized fraud. They settled the lawsuit for about $46 million, but the real damage was to their reputation. The entire brand was built on the phrase, satisfaction guaranteed or your money back. Suddenly that promise felt hollow.
So they spend the rest of the 90s trying to right the ship. They spin off Allstate, Dean Witter, Discover. They try to get back to basics, but it's too late. And that brings us to 2004 and the deal that seals their fate. Kmart buys Sears.
Well, technically. But it's more accurate to say that a hedge fund manager named Eddie Lampert, who controlled Kmart after its own bankruptcy, used Kmart as a vehicle to acquire Sears.
This is the moment we enter the hedge fund era, and I really want to break this down for our listeners. What does it actually mean in practice to run a retail company like a hedge fund?
It's a fundamental difference in philosophy. A traditional retailer, a merchant, believes in investing money back into the business. You spend money on capital expenditures, CapEx. You renovate stores, you update your technology, you train your employees. You spend money today to hopefully make more money tomorrow.
Okay, that makes sense.
A hedge fund manager, particularly one like Lampert, is obsessed with capital allocation. Their only question is, where can I put this dollar right now to get the highest possible immediate return for shareholders?
So if renovating the store gives you a 2% return, but buying back your own stock juices the share price and gives you a 5% return.
You don't fix the leaking roof, you buy the stock. And that is precisely what happened. From 2005 to 2010, Sears Holdings spent over $5 billion on stock buybacks.
$5 billion. They could have rebuilt every store in the country for that.
They could have.
Yeah.
But instead, they used that cash to artificially inflate the stock price, making the company look healthy on Wall Street while the actual stores were visibly decaying. Customers would walk in and see peeling paint, burnt-out light bulbs, disorganized shelves. It felt like walking into a time capsule from 1985.
And here's the statistic from the sources that just floors me. In the third quarter of 2006, 1/3 of the company's entire pre-tax income came from financial trades, not from selling washing machines.
Correct. They were making complex derivative bets, total return swaps. They were using the company's cash flow as collateral to function as a speculative investment fund.
So it was a hedge fund with a department store attached as a sort of cash-generating side hustle.
That's a very good way to put it. And it worked for a little while, as long as the market was going up. But when the 2008 financial crisis hit, those bets went sour. And because they'd starved the retail side for years, there was nothing left to fall back on.
So the profits vanish, the stores are crumbling. What's the next move? You start selling off the family silver.
This begins the period we call the asset strip. If the core business isn't making money, you start selling off the valuable pieces of the company to generate cash to cover the losses.
They spun off Lands End in 2014. They sold their stake in Sears Canada, which then went bankrupt.
And then, the one that really hurt the loyalists, in 2017, they sold the Craftsman brand.
That feels like the point of no return. Craftsman was Sears for generations of American men.
It was the heart of the company for so many people. They sold it to Stanley Black & Decker for about $900 million. Once that was gone, what was the reason to even go to Sears anymore?
But the most controversial deal, the one that led to lawsuits, was about the real estate. Can you walk us through the Seritage deal? It's a bit complicated.
It is, but it's critical to understanding the end game. So, Sears owned hundreds of its own stores, the land and the buildings. This was their single most valuable asset.
Okay.
In 2015, Lampert orchestrated a plan to unlock the value of that real estate. He created a new, separate company called Seritage Growth Properties. It's a type of company called a REIT, a real estate investment trust.
So a company that just owns property.
Exactly. Then, Sears, the retail company, sold 235 of its best, most valuable properties to Seritage, this new company.
And then the catch was?
The catch was that Eddie Lampert was the chairman of Sears, the seller, and he was also the primary investor and chairman of Seritage, the buyer.
So he was effectively on both sides of the transaction. He was selling the assets to himself.
That was the allegation in the shareholder lawsuits that followed. They claimed he engineered the deal to sell the properties too cheaply to his own new company. But the operational consequence was even worse. Sears got a one-time cash infusion from the sale, which it used to pay down debt. But then, to keep operating in those same stores, it had to start paying rent to Seritage.
So they traded a massive asset owning their own buildings for a massive liability, a monthly rent check.
Yes. And it created this perverse incentive. If a Sears store was struggling and went out of business, it was actually good for Seritage. They could then evict the failing Sears, tear the building down, and release the valuable land to someone like a Whole Foods or a luxury apartment developer for much higher rent.
So the real estate company he controlled was positioned to profit from the failure of the retail company he also controlled.
That was the argument the creditors made in bankruptcy court. They called it serial asset stripping. They said the company wasn't being turned around, it was being systematically dismantled for parts.
And while all this is happening, the company is burning through billions. The Shop Your Way loyalty program was a money pit, right?
A complete disaster. They lost $10.4 billion between 2011 and 2016. They were trying to become a tech company, a membership club, but the execution was awful, and customers were just confused.
And what about the employees, the people who had been there for decades?
It was a nightmare for them. Constant commission cuts, store closures with little notice. But the most brutal part was the attack on the retirees. In 2019, after the bankruptcy, the company moved to terminate the life insurance benefits for its retired employees.
These are people who gave their entire careers to the company.
The 30, 40 years. And at the very same time they were cutting off these retirees, court filings show they were handing out $25 million in bonuses to their top executives.
The optics of that are just indefensible.
It cemented the narrative that this was a salvage operation for the people at the top, not a rescue mission for the company.
Which brings us to the final chapter. October 15th, 2018, they file for Chapter 11 bankruptcy.
They couldn't make a $134 million debt payment that was due. The game was up. Lampert stepped down as CEO, but crucially remained as chairman of the board.
And then came this bizarre bankruptcy auction in early 2019. It wasn't a normal sale.
No, it was high drama. The company was on the verge of total liquidation, meaning every single store would close immediately. Then, at the last minute, Lampert himself, through his hedge fund ESL investments, came in with a $5.2 billion bid to buy the remaining assets out of bankruptcy and keep about 425 stores open.
And the creditors, the banks, the suppliers, everyone Sears owed money to, they fought him on it.
They were apoplectic. They argued directly to the judge that Lampert should not be allowed to buy the company. Their position was essentially, this man drove the car off the cliff and now you're going to sell him the wreckage for pennies on the dollar, just liquidate it and give us what's left.
But the judge approved the sale.
He did, primarily on the argument that it would save, at least temporarily, about 45,000 jobs.
So the new Sears is born under a new corporate name, Transform Co.
It sounds like a generic evil corporation from a movie.
It really does. And the transformation has really just been a slow, managed decline ever since.
We call it the slow death. It's just been a steady drip of closures. In 2021, the last store in their home state of Illinois closed. At the Woodfield Mall, their flagship, gone.
In 2022, the last of the Sears Auto Centers shut down for good.
2023, they pulled out of 5 more states entirely. And then came the final symbolic blow, the headquarters.
The massive campus in Hoffman Estates, Illinois.
A symbol of their suburban dominance. In August of 2024, the demolition crews moved in. They started tearing it down.
And what are they building in its place?
Data centers.
You couldn't write a more perfect metaphor. The physical retail giant is being bulldozed to make way for the server farms that power the digital economy that killed it.
It is the perfect tombstone for the 20th century American corporation.
Which brings us right back to today. August 2025, the last store in Puerto Rico closes. December 2025, we hit the final number. 5 stores left. Sears.com still exists, but it's basically just a marketplace for other people to sell their stuff.
Yeah.
It's a ghost ship.
It is.
So let's try to synthesize all of this. We started with a station agent selling watches, and we've ended with 5 stores and a data center being built on the rubble of their headquarters. What is the grand takeaway?
I think you have to see it as a story in 2 acts. Act 1 is a century of relentless, brilliant innovation. They figured out the supply chain, they invented satisfaction guaranteed, they perfected the suburban retail experience, they knew their customer better than anyone on earth.
And Act 2?
Act 2 is what happens when a company falls in love with financial engineering instead of its customers. They stopped trying to innovate in the aisles and started trying to innovate on the balance sheet. They forgot the Why serving the American family and focused only on the assets, the stock price, the real estate.
They started treating the company not as a living organism to be nurtured, but as a pile of assets to be liquidated.
Precisely. And the ultimate lesson of Sears is that you cannot financialize your way into a customer's heart. You can play games with the stock price for a while, you can extract value for a few years, but eventually the customer walks in, sees the leaking roof and the empty shelves, and they stop coming back.
It's an incredible, sobering story, but I want to leave our listeners with one final thought: the big what if.
Sears Prime.
Sears Prime. They had the warehouses, they had the trucks, they had the customer list, they had the consumer's Bible. If in 1994 they had embraced the internet with the same ferocity that Robert E. Wood embraced the automobile in 1925.
We wouldn't be talking about Jeff Bezos today. We'd be getting 2-day shipping on our Craftsman tools from Sears. Yeah. They had a century-long head start, and they let it all slip away because they were looking at the wrong spreadsheets.
And that leads to the final provocative question for you listening right now. Who is the Sears of today? Which corporate giant is sitting at its absolute peak in its gleaming new headquarters, so focused on stock buybacks and financial maneuvering that it doesn't see the world changing right under its feet?
That's the question that should keep every CEO in America up at night. Because as Sears proves, no empire is forever.